Howdy, Jacob here. Today we're looking at Edwards Lifesciences Corporation in the healthcare equipment and supplies industry. 53 billion market cap on 52 billion enterprise value with just beautiful numbers here. We're seeing operating margin grow from 21% to 29%, gross margin go from 73% to 77%, and revenue increasing pretty substantially from 2.3 billion in 2014 to over 6 billion in 2023. Let's look at the balance sheet there. So balance sheet has about 1.6 billion in cash-like assets with only 600 million long-term debt. Beautiful, absolutely lovely. Love to see that. Great balance sheet, extremely safe from a balance sheet perspective. And cash flow, a little bit of, the capital expenditures aren't nothing, but compared to their cash from operations, it's nothing. So close to a cash cow here with a 5-year average, probably looking at maybe 800, 700 million. So that means that of their payout, they're paying less than 10% on acquisitions, probably 5 to 10% acquisitions, reinvesting 5 to 10% because they're divesting as much as they're investing, it looks like, and then a humongous amount on share repurchases. And so use of cash appears to be strictly common stock repurchasing. And for a company that's been growing like this probably for a long time, let's see, when were they? Founded in 1958. Okay, so great growth. If you're growing greater than the discount rate that you're looking for, you're going to be getting fantastic returns, pending you don't buy it at. You could be buying it at pretty much nosebleed prices, and if it grew above your discount rate you're looking for 20 years, it doesn't matter. But obviously, who did that, we'll see. But that's what I mean is when the company's buying back shares that seem expensive to you or me, as someone who may not know the business's full ins and outs, there are going to be times where it looks like they're doing a dollar cost average method where they're just kind of buying back a bunch of shares every single year, not really caring what the price is, which may be fine because sometimes they might buy low, sometimes they might buy high. But if it's a fantastic company, when they buy at those low prices, there's a good chance you could be getting well in excess of 15% return on that money invested by repurchasing shares. So let's start making some assumptions here. I'm going to say, return on invested capital over 20%. Absolutely fantastic company. Let's do 7% revenue growth, 18 on the P and price of free cash flow. I think I'm comfortable with that. And then 15% return. Margins are going up, so I'll probably go on the high end here. I don't like, though, that earnings are higher than free cash flow. It's not concerning because they are gushing out a lot of free cash flow, but it's more concerning to me since you use excess cash from excess free cash flow to do what you want with the business, like acquisitions, reinvest, buy back shares, dividends, or nothing. So margins, let's do 24, 22, and then buy back 1% of shares. They've been buying back a lot of shares. Okay, but stock-based compensation was also pretty high. Okay, so 139 million paid out to stock-based compensation, which is increasing shares, but also increasing insider ownership shares. But then they're buying down a bit more than that, so you're still seeing a net reduction of shares. And, again, right now it just looks kind of overvalued, which, again, if you just look from a P perspective, 38 down to 18, and their growth rate is less than their discount rate. And so you're going to see a fairly large deflation in P and the growth not out-substantiating the rate of return that you're looking for, or at least I'm looking for. Please do your own analysis. Everyone's perspective is going to be different. But for me, I think it's a wonderful company. I absolutely want to own it. But everything is the present value of future cash flow. Every investment is the present value of future cash flow. And I think right now it's just a little too expensive for me. So hope you enjoyed the video, and thank you so much for watching. Have a great rest of your day.